Hello everyone, welcome back to Trading Club 7. You as a beginner, I know one of the most frustrating things about trading is navigating the sea of technical analysis tools and terms, not knowing what they mean or how to apply them. Well, today's lesson is going to help clear that confusion and give you a solid understanding of some of the most important concepts in trading. When we talk about trading, people often throw around terms like bearish and bullish, but do you really understand what they mean? Let's start with the basics. A bullish market is when the price is increasing over time, indicating a rise in investor confidence and a willingness to buy more shares. A bearish market, on the other hand, is when the price is decreasing over time, indicating a decrease in investor confidence and a willingness to sell shares. But what's the difference between a simple bullish or bearish move and a bullish engulfing candle? That's where the magic happens. A bullish engulfing candle is when the price opens lower than the previous day's close, but then closes higher than the previous day's open. Think of it like a tug-of-war between two teams in this case, the bears represented by the previous day's low and the bulls represented by the current day's high. When the bulls manage to push the price up, engulfing the previous day's trading range, it's a clear sign that the market momentum is shifting in their favor. Let me give you a real-life example to make this clearer. Suppose we're looking at a chart of Apple Inc. Apple and see that the previous trading day closed at 100. However, the next day opens lower at 96. But then, the bulls come in and push the price all the way up to 110. Closing higher than the previous day's open. That's a bullish engulfing candle, a clear sign that the bulls are in control. Now, let's talk about why this matters. When you see a bullish engulfing candle, it's a strong indication that the market is shifting in favor of the bulls, and you can expect the price to go higher. However, keep in mind that trading is never a guarantee, and the market can reverse at any time. It's essential to remember that these types of indicators are just a hint and should not be the sole basis for making trading decisions. One of the most common mistakes beginners make is getting caught up in the hype of these bullish candles and jumping in without proper analysis. They see a bearish candle followed by a bullish candle, and their initial reaction might be to buy, without thinking about the broader market conditions and trends. But trading is not just about reacting to the immediate price movement. You need to think critically about the underlying factors driving the market, such as economic indicators, industry trends, and even global events. For example, suppose you see a bullish engulfing candle in a commodity like oil. While it might indicate that the bulls are taking control, you need to also consider the impact of recent global events on the oil market. Were there any natural disasters or production disruptions? Did the OPEC nations agree to new production quotas? These factors can have a significant impact on the price movement, so it's essential to stay informed and keep them in mind when making trading decisions. Now, let's talk about risk management techniques. Risk management is all about protecting your capital and mitigating potential losses. One simple technique is to use stop-loss orders. A stop-loss order allows you to set a certain price at which to sell a security, automatically closing out the position before significant losses occur. This is especially important when trading with leverage, as the potential losses can quickly add up. Another risk management technique is position sizing. This involves adjusting the size of your trades based on the amount of capital you have available. For example, if you're trading with a small account, you wouldn't want to put all of your eggs in one basket. So, you would adjust the size of your trades to ensure that even if the worst case scenario happens, you won't lose too much. Finally, let's talk about the mental approach to trading. Trading can be emotional, and it's essential to manage your emotions to avoid making impulsive decisions. One technique is to use a trading journal to record your thoughts, feelings, and outcomes. This will help you identify your strengths and weaknesses and improve your decision-making over time. Okay, now it's time for a practical exercise. Open up your charting platform or paper trading journal and practice identifying bullish engulfing candles in different market conditions. Look for situations where the previous day's close was lower than the current day's open, but then the price closes higher than the previous day's open. Analyze why these candles might be occurring and how they relate to the broader market trends. For homework, I want you to take a look at the recent chart movement of the S&P 500 index and find at least 3 instances of bullish engulfing candles. Write down